Mr. Tony Fedula.
Thank you. Thank you. So what did you tell your mother-in-law? It obviously worked, whatever it was here. Happily married.
I asked the question was the first key that I truly said. I said, let me find out and get back to you.
I'll get back to you on that. Good.
Pretty good idea.
Well, this is a pleasure for me. I normally present to advisors like Nate or his colleague Sean, and it's not often I get the opportunity to speak to the public. It was my career early on in my financial history there, but I didn't get that opportunity once I got into management. We're doing other things with the firm, so I've re-embraced that. And today I'm going to share with you a couple of ideas here, some thoughts about what really makes investing work. Many people are a little confused on that. We're led to believe from the media that it's about buy low, sell high, finding the right stock at the right time, then selling it when it goes up. And there's some truth to that, but you'll see that over long periods of time, there's a little secret to investing that I will reveal for you today that's been in front of us all this time. First, a little bit about myself. I have had a long history in the business. I began literally as a kid. I was 16 years old, got my first job in the industry, working for a big firm, Merrill Lynch. I worked in the back office, processing trades, processing new account forms, securities delivery, all calculation of balances, etc. I was learning all of the mechanics behind the business. But it wasn't lost on me that the real fun of the business was in the front office, right? That's where the Tickertron tape was, and the phones are ringing, and all the excitement was going on. So I knew that's what I really wanted to do. So I kept my job through high school, worked my way through college, 4 years of college, got my degree, and I went in for my big interview with the boss. And I said, sir, I want to be one of those people, one of the people out front. And he challenged me on that, of course, and he said, why? Why do you want to be one of those people out front? I hadn't given it a lot of thought. But in reflecting on it, I thought of the words of Sir Winston Churchill. Never before had so many done so little and made so much. I'm like, come on now, this isn't hard work. My dad was a machinist by trade. He worked hard in a factory. I knew what physical labor was. These guys are talking on a telephone. So you buy and sell stocks. How hard could that be? Buy low, sell high. I got that, right? Well, he liked me. He'd known me for 6 years. I had worked very hard. He gave me my chance. I went off to the training program at Merrill Lynch in New York. And upon graduation, after 3-4 months of this, we had a big dinner, and our speaker was Donald T. Regan, chairman of the board of Merrill Lynch. You might remember that name, Don Regan. He served in the Ronald Reagan administration, Secretary of Treasury, later Chief of Staff, had that falling out with Nancy over the astrology thing, different story. But Don Regan looked at all of us young people in that room. He said, you all are coming into this business at the best possible time. Anybody here hear that line? Yeah, okay, makes you a little suspect. But Don Regan had said it because the Dow Jones average had just closed at an all-time record high. We'd broken through 1,000. This was December of 1972. And he made a bold prediction for us. He says, you all will see in your careers a Dow Jones average over 5,000. Now, that doesn't sound like much today. The Dow's currently over 17,000. But imagine the power of that prediction, if you would. 5 times a record all-time high. Record all-time high. That would be me saying to my young colleague Christopher there, you'll see a Dow Jones average over 85,000 in your career. 5 times the all-time high. It was an incredible projection. And of course, it came true and then some. So I got back, I'm pretty excited to begin my career, opened my very first account, bought all kinds of stocks, and I would learn over the next 18 months that Don Regan left out a small detail, that on our way to 5,000, we'd see it in half first. 18 months later, it's October of 1974. After a brutal 18 months, the Dow is trading at 585. I'm not feeling good about my career choice. I don't play poker. My face shows everything. So I'm looking particularly dejected and depressed. I'd had a bad day that particular day. My first account I'd opened up, called up that day and sold those stocks at a terrible loss. I must tell you, I don't think my mom ever did forgive me. Not mother-in-law, mom. And the manager sees my face and he calls me into the office and he sits me down. He says, Tony, I'm worried about you. You seem depressed. I'm like, where's this guy been? And I'm a young kid, so I said, sir, with all due respect, this business sucks. I don't get it. Everything I've done has been wrong. Buying the wrong stocks, the wrong time. All I've done is lose people's money. Being the good mentor that he was, he got up from his chair, he put his hand on my shoulder. He said, son, get a hold of yourself. Things could be worse. It's not your money. Well, he did it to get a reaction out of me, which he did. And he began to give me some information, some perspectives on things I never got in training school. Long-term perspectives. He'd been in the business for over 35 years. And began to teach me that it's not about buy low, sell high. In all of his long career, he says, I've never figured that out. You never will either. You're never going to make a career, you're never going to help people by trying to figure the stock market out. The stock market will do what it's always done. Okay, you just got to figure out what really makes investing work. So I learned my first lesson about how investing really works over long periods of time and growing wealth, as Christopher said, by owning businesses, owning companies, and sharing in their success and their profit. That's investing. And this example here, we used Grandma because it was Grandma who used to buy those dividend-paying stocks. The utility stocks, AT&T, the stock of widows and orphans, wasn't very exciting, was boring. No exciting products or technology going on there, but steady dividends were paid, and that's what the investing was about. I thought for many years, well, that's what that was for. Dividends are a little something to go with. Well, I'll go in 3 parts today on this presentation to show you, if I can go backwards on this, life is like a box of chocolates, okay? There we are. Dividends. Dividends have historically outperformed. We think of the growth stocks, we think of the exciting and the technology stocks or the new products and the innovators as where all the action is in the market. But over long periods of time, the dividend-paying stocks have actually been the best performers. That surprises a lot of people. They don't get the press, you don't get the fanfare. You're not going to hear about them on Kramer, on CNBC, jumping on his chair, talking about the earnings report that day. But you'll see over long periods of time, those dividends really add up. The second thing we'll talk about is why. Why would this work that way? What have we missed here? Why is that going to give me a better performance? And then finally, I'll wrap up with talking about today's market, this environment that we face as investors, where interest rates are, where the markets are at these levels, and why and if it makes sense for investors today in this market to still look at dividends as an investment strategy. So let's proceed and talk a little bit about Grandma here. Most people look at dividends, they say, okay, if you take a look at what the market did this year, it paid about 2% in dividends and it was up 10% total. Well, most of that was, of course, was appreciation. Very little was dividends. If you look over long periods of time, at first glance, it appears that's how it usually works. This took information all the way back to 1926. And looking at it that way, you see on this left-hand side here that you have a chart that shows you that 5.8% of the market's move over that period of time in any given year was from appreciation and 4% was from dividends. So the bulk of it, appreciation. Less so was the dividend itself. That's how it was split in any given year. However, if you've held stocks over this period of time, what's happened to profits? What's happened to earnings? They've gone up tremendously. If you take a look at Exxon, for example, used to be Standard Oil of New Jersey back then. What they paid in dividends in 1926 versus what they're paying in dividends now, it is some multiple of 10, 12, 15 times the amount of money that was being distributed then. Dividends have grown. If I've held stocks over this period of time, I've collected lots of dividends. I've compounded my return, and my dividends have grown steadily every year. We don't live in a one-year snapshot. So when you look at the bigger picture here, dividend growth, when you add that together with the dividends, you see that it dwarfs what's happened in terms of the price movement. All these wonderful charts you get that shows you what the stock market has done from 1926 forward and grown all this wealth, the bulk of it has been dividends and dividend growth. Only that 1.1% has come from valuation change. So the buy low, sell high, although it looks exciting, it looks in the short run, that's how you make money, and perhaps you can do that in the short run if you're lucky. The real returns for investors over time have been driven by dividends and dividend growth. That's how the math breaks down. That's where the real opportunity and the returns have been made. Now, we took a little further in-depth look at this same information and said, okay, Let's look at more recent history. We went back to 1972. I looked at 72 because that's the year I got my license. And it incorporates a pretty deep bear market. 73, 74 was brutal, and we brought it forward to include even the recent financial crisis. And let's test this theory about dividends. What has worked in this time? We took a look at the S&P 500, these 500 stocks. We said, during this period of time, what happened to the companies that didn't have dividends? They eliminated their dividends or they cut their dividends. Things hadn't gone well and they stopped paying their dividends. If that's all I had owned through that period of time, I had a negative return, you see. If I had those companies that were just non-dividend payers, they didn't cut, they didn't raise, they just never paid them, I had 2.3% return. How about this? The stocks that have paid dividends but didn't really increase them on a regular basis. They just let it the same. Those dividends never really grew. I did okay, 7.65%, but the real return for investors came from those stocks that not only paid steady dividends but regularly increased their dividends, or for the first time initiated a dividends. Dividends made a profound difference in the return, 10.7% versus for the non-dividend payers, 2.3%. Again, further evidence during this more recent period of time, dividends, including some pretty deep bear markets, made a huge difference to the investors. The dividend payers were the ones that people really made their best returns on. Looked at another way, this is some information from Dr. Jeremy Siegel. Now, Dr. Jeremy Siegel, you may have seen him on CNBC sometimes. He wrote a book. It's called Stocks for the Long Run. I recommend it to you. It's a great book. It's written for lay people. You don't have to be an investment person to read it. It's in very simple language and a lot of graphic examples. His life work has been studying the stock market, and he studied it all the way back over 200 years of data that's available on investing. And in this book, and he put out a new edition of it, by the way, this year, 2014, his 5th edition of the book, so it's quite up to date. It includes the financial crisis, very current information in it. But he took a look at dividends. And you look at the S&P 500, these 500 of some of the largest companies that you can invest in. He says, I'm going to break them down and categorize them by one thing. I'm going to look only at dividends. I'm not going to look at the products they have, industries. I'm not going to look at earnings rate and earnings growth. I'm going to look at one thing, just dividends. I'm going to take these 500 companies and put them into 5 groups of 100 stocks each. Very simple. And I'm going to look at dividends. I'm going to categorize those stocks that don't pay any dividends, low-paying dividends, average payers, above average, and the highest dividend payers. And that's going to be my investment strategy. I'm going to take it back as far as I can track the information. This index was created by Standard & Poor's in 1957. That's why it begins at that date. I put $1,000 in, that's his hypothesis, $1,000 in to each of these 5 different groups. No dividend payers all the way up to the highest dividend payers. And look over time what happened. Those companies with the higher dividend yields produced superior returns. The non-paying ones, if I put my money into all the non-dividend paying stocks, my $1,000 grew over that period of time to $100,000. 100 times fold of my money. That's not bad. Had I bought the higher paying dividend stocks and every year rebalanced to make sure I only had the best dividend paying stocks, at the top point you see $677,000 for the highest dividend paying stocks. Evidence that dividend strategy was a superior way to pick stocks. The averages, the no-brainer. What if I just bought the S&P 500? I'm doing the no-brainer. The index, as we call it. I'm just going to invest in all of them. The S&P 500, how did I do? Not bad, 201,000. But as you can see, dividend paying was superior. Now we measure risk, volatility in the market with something called beta. You hear that term sometimes. Simply put, we compare our investment strategy to how it did to the average, to the S&P 500. If I simply bought the average, that beta, that volatility, of course, is the average. It's 1. Something less than 1 means I had less volatility. So if you'll notice in that little block there, you'll see the mid to higher dividend paying strategy had lower volatility, less volatility than the average. This is pretty much the holy grail of investing. Higher returns with less risk. Again, what was the strategy? Dividends, not just the buy low, sell high. Most people don't see that. Most people see stock investing as this quote here from Forrest Gump. Life's like a box of chocolates. You never know what you're going to get. You remember that quote? And they see all these stocks and they see these different reasons and selections to have there, different industries, who's got different products, what's hot, what's not hot. Perhaps you listen to television and the talking heads there. That's really not a great way to invest. If you take a look at the history of these companies, these businesses that you can invest in, it's all there in front of you. There are long histories of these companies that have been in business for decades, through many economic cycles, through a long, long period of time of earning profits, growing profits, and sharing those profits with their shareholders. Dividends. So you can see that you don't have to buy a pig in a poke. You don't have to invest in the dark if you've got long-term track records, a commitment of management to distribute some of those profits to their shareholders. So we think that there's a better strategy. The buy low, sell high philosophy out there will always be there. Today's bull market is now getting to be 6 years old coming up this March. I mean, it's been a long time of advancing stocks in the market, and it's beginning to look a little easier. Investing is easy, isn't it? Must be easy. That's the impression you get in watching the ads on TV. I watch a lot of TV. I'm on the road a lot, so I'm stuck in airports. I watch television. And sure enough, you watch it long enough and an ad comes on, and there's a baby in a crib trading stocks from an iPad. When did it get to be that easy, right? Oh, you just buy low and you sell high. I'm reminded of the quote from Will Rogers, the famous humorist there of the 40s. And the markets had recovered. We're out of the Great Depression. And a writer there asked him, he said, Mr. Rogers, what do you think of this stock market? He says, I think you should buy good quality companies low and then sell them when they go up. Of course, the writer said, what if they don't go up? He said, then don't buy them. That's really where the fallacy of that strategy is. But when you take a look at the history of these companies, and good companies, and long-term businesses, and products and things that are very consistent over time, you get a pretty good idea of how good the management is, their ability to grow those profits, and their propensity, their willingness to share those profits with the owners, who are us, their shareholders of these companies. Now, this is a great example, a real example, of where dividends far outperformed growth, okay? I use this example of Apple because it's popular. Everybody knows Apple. They know how hot the company's been, the great products they've had over the last 10, 15 years, the meteoric growth that the company has experienced worldwide. They've done quite well. And if I was an owner of that stock and I bought it right there and when it was first offered in 1983, bought myself some Apple stocks. Through all the ups and downs and the growth out there, I had a very good return. You'll see my price return was nearly 15,000 times my investment. That's pretty doggone good. My total return, including the dividends that they've paid, which has only happened recently, is about almost 17,000 times my original investment for a compounded annual growth rate, by the way, of 18.6%. Who wouldn't want that? It's exciting, it's growth. Those are the kind of companies you want to own. But I found a mundane stock that has outperformed it during that same period of time that surprises most people. You never would have expected this, but a stock that has vastly outperformed that is Philip Morris. Surprising, huh? Not the kind of company you think would have done well over the last 25 years, huh? Heck no. Why? Well, cigarettes are killing people. This stuff's bad. We're going to ban them everywhere. How's this ever going to work out? And they've got other investments, and they diversified the company. But take a look at this performance, and let me break that down for you. You take a look at what the price appreciation has done, nowhere near what Apple has done in terms of price movement. It's just a fraction of it, you know. It's done well as everything has over that long period of time, but nowhere near as well as Apple has. Look at the difference in total return, however. It's much, much higher, and their compounded annual growth rate is 20% per year. Why? Dividends. Philip Morris did one thing through this entire period of time. They continued to pay dividends. They grew those dividends. And through the compounding of that and through the magic of the press keeping the price down on Philip Morris with all this negative news, you were able to buy more shares at very reasonable prices and continue to compound it. You see, investing isn't always about the hot product. It isn't about the headlines out there. It's about consistently growing profits and the dividends that are paid to the owners of that business. Another great example of where dividends have been the superior way to invest over time, even in today's world. Now, real estate is a great example to use because people understand real estate. In my early days of convincing people to invest, this was the biggest competitor. It was hard. I said, well, I'd like you to put your money into some stocks or bonds. Oh, no, we buy real estate. Why do you buy real estate? Because it always goes up. And that was true until recently. Then it wasn't true anymore, you know. Now, real estate can have some issues too, you know. So if my business, if I looked at stocks the same way I looked at real estate, and I thought, oh, I'll just buy and sell in real estate, it doesn't always work. That adage about it always going up, you can have periods where it doesn't. Flipping houses, flipping stocks. That's not where the real money can be made in real estate. Think about owning rental properties that have continued to pay rent and have continued to grow those rents as inflation has increased, and you get a better idea, a better visual of how stocks have paid off with dividends for their shareholders versus someone thinking of, I'll buy the house here, I'll sell it at that price. It's a good example in terms of investing, having income coming from your property rather than trying to depend only on price movement of the real estate. A better strategy. And as promised, I'll talk about today's world. Today's world is one of very low interest rates. Interest rates have been remarkably low for a long period of time. Now, we all expect them to go back up. Anybody here expect interest rates to go back up? Yeah. We all do. Of course we do. When are they going back up? Don't know. No one does. When are interest rates going back up? In fact, when I usually close my presentation, I ask for Q&A, any questions you might have. Most often the first question I usually get is about the stock market. Lately, it's always been, what about interest rates? When are interest rates going back up? We need higher interest. We need more interest on our money out there. Well, this Federal Reserve policy, which, by the way, has an economic term and is known as financial repression. Financial repression, you're being forced into a lower rate of return. And this economic repression usually encourages capital to go into more riskier ventures there and encourages borrowing, usually stimulates the economy. That's the reason for it. It's not the first time this has happened. If you go back historically, over Federal Reserve policy, you will find there was another period of time. In 1946, the interest rates were forced down to almost zero by the Federal Reserve. And they kept those rates low for about a decade. Why? What had just happened? World War II, we had a mountain of debt in this country, not just in terms of aggregate dollars, but as a percentage of our gross domestic product. So the Federal Reserve was, by doing two things, by keeping interest rates very, very low, we were able to begin repaying that debt at a much lower rate of interest. And also, it was to stimulate the economy. You had millions of veterans coming home at a time when the war economy was shutting down. We needed to create jobs, create opportunities, get this economy going so we wouldn't go into a big depression. So that went on for quite a period of time. And the question is begged then, well, what happened when they took the cap off? When interest rates were allowed to rise, what happened? Well, that happened in 1956. From 1956 till 66, 10 straight years, the market by and large, went up into one of the biggest bull markets ever. So I don't fear rising interest rates. The Federal Reserve will begin to let interest rates rise as the economy strengthens, as job growth begins to get more robust, and as inflationary fears, once again, raise their concern. In the meantime, and this can be a long period of time, as you have seen, you've got very low interest rates. We all remember the heyday there of the early 80s and interest rates. Some people say they were the good old days. I could point out to you those were not the good old days. When interest rates were up at those levels that you see in the early 80s, inflation was running nearly 25% per year. You couldn't earn money fast enough to keep up with the movement in prices. There was a reason why the Federal Reserve jammed on the brakes to slow the economy down. And then a steady decline in interest rates there in that 10-year Treasury. This is what we have. There's been some uptick recently, but it's going to be a prolonged period of low interest rates. what is an investor to do? We think the other appeal of dividend-paying stocks, not just the growth of our wealth there in terms of owning stocks and benefiting from the dividends, it's the alternative that we have in terms of investing our money. Low interest rates. Dividend strategies begin to look more attractive for those people seeking to get fixed income, to getting some payment on their money, not just compounding it. We think these low interest rates are with us for a while. A little bit of uptick over the next 12 months, but a long, prolonged period of very low interest rates means dividends still look very attractive. If you take a look in terms of what we have failed to do as investors, why we haven't benefited as much from the dividend strategy, why we've sought out the buy low, sell high, this is the tale of what has happened. Look how long that holding period used to be. People would buy stocks before and you hold them for a long period of time. You hold them and you benefit from the growth of the company. You benefit from those dividends distributed. In the 40s and 50s, even the 60s, long periods of time of holding stock. Thanks to television, CNBC, the internet, E-Trade, so easy to trade stocks out there, we have embraced that completely. In the last decade of the 2010s, the average holding period for a stock on the New York Stock Exchange is less than 6 months. Hard to make money in dividends if you're holding a stock for 6 months. For some people, 6 days. You're not there for those returns. You're not there to collect the dividends. Dividends are distributed on a quarterly basis. So if I tell you this stock has had an annual yield of 4% in dividends and you hold it for a day, that has nothing to do with you. You're not there to collect the dividends, right? It's one of the challenges that people haven't embraced the dividend strategy. We're still trying to buy low, sell high, and you're being encouraged to do so by the media at every turn. We think there's room for growth in these dividends. If you take a look at what American businesses pay out in terms of their profits to their shareholders versus the rest of the world, we're very miserly. American companies have done a great job of hanging on to their capital for various reasons. Sometimes it's to invest in new plant and equipment. Other times they're hanging on to because they want to do acquisitions. We're going to keep the cash here in the treasury because we want to make an acquisition. We're going to buy some other companies out there. Not every company has that philosophy, but it's one of the reasons why we're a little stingy in paying out. We think there's room to grow. A lot of the developed world, a lot of very large corporations in other countries pay out a much larger percentage of their dividends. We think the pressure is on for American businesses to begin to increase that. We're still at historically low payout rates. Long-term averages in terms of what we've paid out in dividends are around 40%. 40% of earnings are distributed to the owners, to the shareholders. Right now, on average, we're about 28%, so there's room to grow there. And in terms of the availability of cash, that same S&P 500, these 500 largest companies, are awash in cash. Their balance sheets have never been stronger. The financial crisis has made all of corporate America a little nervous about debt. It's made them hoard a lot more cash. There's a lot of cash to be distributed. So we think the propensity for growth in dividends is very strong over the next decade in terms of owning businesses. Oh, this is the disclaimer from compliance. It says everything I just told you isn't necessarily true. Well, these things are written by lawyers for lawyers. Investing is a complex business. We at Federated, we run about $400 billion in assets here, and they're entrusted to us by trust departments, banks, financial advisors, such as you work with here in this fine firm out there. But we don't deal directly with the public. There's a reason for that. We believe that every individual in this room should seek out sound investment counsel with someone who understands you, your needs, what your portfolio, what you're trying to do with your money. It's not a blanket one-size-fits-all process out there. Some people are willing and able to take more risk. Other people want less risk. Some people want to be collecting their dividends. Other people want a strategy of accumulation. Seek that advice and you'll find this will work in your favor. My purpose in this presentation was to point out the lowly dividend that Grandma collected there on her little AT&T stock, for example, is actually not a bad strategy if you want to compound and grow money over a period of time to accumulate some wealth. That's my formal remarks, and I'm delighted to answer questions. I've come from over 100 miles away, and I brought slides. I'm the out-of-town expert you've always read about.